pharma actually started going through improved time in the last 15-18 months. So we'll discuss this space with someone who's very well respected in this space, Mr. Aditya Khemka, who is also the healthcare fund manager of DSP. In fact, he recently had a conference call regarding the space as well, which was very well attended, and his views generally are very well respected. Aditya, thank you very much for your time. As we were discussing in your conference, on your call as well, that actually the improvement in the fundamentals of the space started happening 15-18 months back, but they were too subtle. But right now, because of perhaps what is happening in the environment due to COVID, investors have suddenly caught the fancy of this space, and everybody wants to be positioned, be it a trader, be it an investor. My question to you is that do you think that pharma valuations are attractive even now? Because the fancy right now is only 2 weeks old. Do you think that the prospects look good for 2, 3, 4, 5 years compared to the crunch this space has gone through in terms of valuations and in terms of deteriorating fundamentals in the last 6 years? All of that is reversing now?
Yeah, so a couple of things there. Firstly, if you look at the 10-year average valuation premium of pharma to the broader market, so pharma roughly trades at a 35 to 40% premium to the broader market on a 10-year average basis. And while a month back the pharma sector was trading at like a 10% discount to the broader market, after the recent rally we have come back to that 10-year average. It has sort of been a reversion to mean for pharma over the last month or so. So we are at the average number right now. Now, if you think about the peak valuation that pharma saw in 2015-16, the multiples then were at 130-140% premium to the broader market. So we are far away from the peak valuation. We are very, very close to the average 10-year average multiples for pharma. So that's the perspective on valuation. So I wouldn't say that the rally is done or something like that. I think there is room for valuations to re-rate, provided return on equity improves for pharma companies from where they are right now, and that is the broader expectation, that the return on equity would improve. In terms of what was the issue with the sector in the last 4 or 5 years, so there was a significant deceleration in the momentum of the export business. The pricing pressure was immense, and that led to the ROEs declining from what we saw in 2015 to what happened in 2019. So in 2015, the peak ROE of the sector was about 27%. Today, that ROE has, in 2019, that ROE came down to about 10%. So there is a lot of room for ROE to improve from this point onwards, right? So that's the perspective really, Ajay, and I feel the pharma sector will continue to do well even in these tough times because it's been classified as an essential service, as you know. And this is one consumption which is absolutely involuntary in nature, non-discretionary in nature. We saw people stocking up medications in being afraid of a stock out or a lockdown, and that only helped the sales of the pharma companies. Yes, there are challenges in terms of hospital OPDs being shut, patients not being able to go to physicians for a diagnosis, etc. But relatively placed very well in the current environment, Ajay.
Aditya, let's break it up. What is happening right now is that everything which has got pharma to it is getting excited. But if you take 3 to 5 year horizon, companies which have got higher earnings profile and better valuations, good management quality, all of them will far outperform others. And there is no uniformity in those metrics. Talk to me about the kind of companies you like or the profile of companies. I don't take names, but talk to us about what companies in domestic pharma, what kind of work has got good potential going forward. What about MNC pharma? What's the outlook there? And also, how has the US pharma market looking after the growth had decelerated again, had gone down? Is it coming back? Talk to us about the outlook on these 3 fronts.
Sure. So I'll take the US question first. So see, the US business saw significant price erosion over the last 4 years. And that, as you know about price erosion, it goes directly to your bottom line, the cost of the price erosion. It suppresses your profitability very, very significantly. It went to a point where, some pharma companies were not even making a decent gross profit on some of their products. Yet they were selling those products to maintain sort of a basket approach. But I think what we have seen in the last 12 to 18 months is we have seen improvement in the US business. The price erosion has stabilized. So it was earlier at a mid-teen level on a basket basis, a mid-teen price erosion year over year. Now that has come to like a low single digit to a mid single digit price erosion, which is more like the 10-year normal. That's the good part of the US business recovery. What other factors we have seen is we have seen some sort of a contraction in supply in certain pockets. So some of the very large pharma companies, don't want to do this plain vanilla generic business anymore because they don't find the business lucrative in terms of ROE or margins. And they are sort of either vacating the space or they are reducing the product basket that they used to originally offer. And that is resulting in some sort of a shrinkage in supply. Now, as you know, in any market, if the demand stays what it was and the supply decreases, then pricing gets a bit of an impetus, right? So I think that's what we have seen in the US market in the last 12 to 15 months. And that should continue going forward because I don't see some of the larger players getting interested again in this space anytime soon. In terms of the domestic market and what sort of companies we like, so the portfolio that I run that has about 40% exposure to companies that have predominantly domestic profitability. They may have some export exposure, but their current cash flows, their current EBITDA largely comes from their domestic business. The reason for maintaining that sort of a mix is, the domestic market in pharma is a branded market. The brand acts as your moat, protects you against competition, against price erosion, against market share loss. The export market is more like a commodity market. So their price erosion is a norm, their competitive threat is higher, and there, you just don't have any differentiation between your product and the next guy selling the product. So if you want to have a product portfolio where we want to have a portfolio of companies where the brand is the larger pull and not a commodity, which is a push. So that is how we have, sort of focused our portfolio on. We are higher weights. We have higher weights on companies that depend more on their domestic rather than the export business for their profitability, current profitability.
Right. Aditya, I want your thoughts on how API business in India is doing. Earlier, it was just, one of the leaders was Divi's high margin business, and the way it is getting re-rated in the market, all-time high once again. But many other, in the industry are saying that companies which are setting up API business or growing their API business very well could be the area of interest or potential from here on. And this is one area up till now not really scaled up by many companies. There are fewer companies, very few companies. So Indian companies which scale up their API manufacturing capabilities, R&D led, what's the future of those kind of companies, both to supply it domestically because there's a large API requirement domestically as an alternative to China import, and also as a export opportunities to large regulated markets like US or perhaps Japan for that matter?
That's true. So API and key starting material both. This is a very large business opportunity that's coming India's way. As we know, China was the dominant. China is still the dominant country to manufacture these products. But the current environment and the environment that has been prevailed in China over the last 2 to 3 years sort of has told other players, which includes Indian players and players in America or Europe, that these Chinese supplies you can't depend 100% on a Chinese source, and they have to diversify themselves, which is why we see a lot of these customers now looking to get a second source or a third source out of India. So the approach is either China +1 or China +2, and they want to get alternate sources developed and want to source some percentage of their volume from India, etc. So companies which are doing capex right now, setting up capacity in the API arena, will benefit from the diversification of these larger pharma companies who want to procure from materials other than from China. So there's a huge amount of demand. You mentioned DV, so yes, I mean, they have done a huge capex this year. They'll probably do another round of capex next year. There are other pharma companies like Dr. Reddy's who are very, very large in the API space. Ipca Laboratories, again, significant player in the API space. They will all benefit from this diversification that is happening from the Chinese zone. And our portfolio, again, with the DSP Healthcare Fund portfolio, it's very well positioned in that space. We do have a lot of weight in companies that are building capacity and have capabilities to manufacture APIs and key starting materials.
Right, I was going through your portfolio, some very interesting names there. In fact, in the last 1 month, I'm sure your fund NAV must have surged quite a lot. All right, Aditya, always wonderful to chat pharma with you on the channel. Thank you so much for taking time out for us today.